The market's in turmoil and some investors are starting to panic. But what if I told you that this chaos might actually be our greatest opportunity? Well, that's just what my chief financial advisor, Tallulah, just told me here. Felix and, of course, Tallulah here. And today we're going to dive into a fascinating interview with Tom Lee, the head of research at Fundstrat. We're going to unpack Lee's surprisingly optimistic take on this September turmoil, his thoughts on a potential soft landing, and why he believes that we're on the cusp of a massive buying opportunity. But that's not all. We're going to be comparing his views with a recent Goldman Sachs report to give you a real insight of what institutional Wall Street is thinking. The kind of stuff they don't really want you to know, so stick around. But no matter which direction the market is heading into, our teaching portfolio is up 93% this year. That's, of course, all to Tallulah's smart planning. And we are hosting our first ever 2-day beginner challenge, where I'll teach you how to set up the trades, how to automate profit taking and manage risk, all in just a couple of hours a week. So if you're keen to learn that information for free from an old banker and his cat, then come and join us next week. I'll put the link down below in the description. I'll put it on the screen as well. Grab yourself a free spot before they all go. Right then, let's dive into Tom Lee's and Wall Street's market insights here.
Well, it's been a rough week. I mean, this September first 4 days were down 4%. It's actually one of the 5th worst Septembers since 1928, so it's pretty bad.
Well, it's quite a sobering start to the month, isn't it? And Lee isn't mincing his words. We did drop 4% in just 4 days. And you might think, yes, Felix, but we've recovered since because Nvidia has given us some bit of light at the end of the tunnel, and that's true. But traditionally, September is a bad month, not because September is a bad month, but because the last 2 weeks of September are a bad month. So I'm sorry to break it to you, the worst is about to come. And secondly, October doesn't get much better when you have a US presidential election coming up. But Lee doesn't believe this downturn is fundamentally justified. So let's hear his take on this.
I don't think there's actually a lot of fundamental arguments for why stocks are down this much, but I think we've pulled forward seasonality. This September to November period last year was really tough. Historically, it's tough, and I wonder if markets are going risk off early.
So Lee is basically suggesting that we are experiencing a temporal compression of market behavior. Typically, September to November can be a challenging period for stocks, a phenomenon often referred to as the September effect. But Lee posits that we might be seeing this entire seasonal downturn condensed into just a couple of days in September. I'm not necessarily with him on that. I think it might well get worse to the second half of September, but we'll find out who's right in a moment. If you look at historical data, the S&P has fallen on average 1% during September since 1928. It's the only month with a negative average return. October and November aren't that much better, often marked by increased volatility. But Lee's theory suggests that this early downturn might actually be a positive sign. If we've indeed pulled forward the typical seasonal weakness, it could mean smoother sailing ahead. Now let's compare this with Goldman Sachs' perspective. And Tallulah, do you have any thoughts on what Goldman Sachs said there? No, she's already done all the hard research, not going to tell you anymore. But Goldman's, the bankers with the big heart, suggest that current market pricing isn't reflective of a recession. In other words, they're seeing the glass as half full, much like Tom Lee. So we've got Lee and Goldman Sachs to be singing from the same hymn sheet. They're suggesting that this downturn, while sharp, might not be indicative of deeper economic troubles. Indeed, it could be more about timing and sentiment rather than fundamental issues. Now, of course, as Tallulah here would tell you, past performance doesn't guarantee future results, but understanding these seasonal patterns has certainly benefited us a heck of a lot in our trading adventures, hasn't it? We've done very, very little this September. We've been very, very choosy with our trades for the reasons that we know everybody is freaking out. So let's turn our attention to maybe the more contentious topic, and that's the possibility of a soft landing. Tom Lee has some rather intriguing thoughts on this matter. So let's take a listen.
The reason I don't think it's something worse, and we don't know, is that the jobs added was better than July. Remember, July was the hard landing fears because it was such a weak number. And in fact, the number of industries adding jobs jumped to 53%. That's the best in 6 months. And the unemployment rate fell.
So Lee is zeroing in on employment data here as a key indicator of the economy, essentially. But digging deeper into the details, that 53% figure he mentioned, referring to the percentage of industries adding jobs, is kind of noteworthy. It suggests a broadening of economic strength across the sector. Now, whether or not you believe US employment data is a whole different kettle of fish, but if we just look at the unemployment rate, it's been hovering around that 4% mark. It's an historic low for the longest stretch since the 1960s. And this persistent strength in the labor market is kind of the crucial pillar of that soft landing scenario. I do agree with him on that.
So I think we're at a point where the Fed could engineer a soft landing.
Now, Lee's confidence in the Fed's ability to navigate this economic tightrope is quite remarkable. It's worth noting that achieving a soft landing, cooling inflation without triggering a recession, is a bit like, I don't know, landing a jumbo jet on a postage stamp or something. It requires timing, precision, and a lot of luck. Interestingly, Goldman Sachs seems to be singing a similar tune, though. Their economist see only a 20% chance of a recession over the next year. They're not quite as bullish as Lee, but they're certainly not in the doom and gloom camp either. So if Lee and Goldman are right about the soft landing, the implications for different sectors could be significant. We might see continued strength in consumer discretionary sectors, steady growth in technology, and perhaps a rebound in interest rate sensitive areas like real estate and financials. Certainly seen the financials in the last few weeks. But the trillion-dollar question that I asked Tallulah this morning is this soft landing scenario just too good to be true? Are Lee and Goldman Sachs being overly optimistic, perhaps because they're flogging something? Well, let's turn our attention to the Federal Reserve and its interest rate decision about to come out. Tom Lee has some rather intriguing thoughts on this matter. Let's take a listen.
And that's why 2 weeks from now it's going to be important.
50, 25, does it matter to you?
Lee's, of course, referring to the upcoming Fed meeting, where the central bank will decide whether to cut interest rates by 50 basis points or 25 basis points. And that's the crucial thing here. Lee doesn't think the number itself really matters.
I think it's going to be how the market interprets either number, because there can be such thing as a dovish 50 or a hawkish 50 or a panicked 50. Even a hawkish 25.
So Lee is suggesting that the market's interpretation is more important than the actual number. And I agree with him on that. I always think with interest rate decisions, the important thing isn't the number. It's the press conference afterwards where we get a feel of, well, what are they going to do at the next meeting? Are they likely to keep cutting more kind of no matter what happens? Or is this sort of, we'll do one and we'll wait 3 months? That's kind of what the market wants to see here. But either way, Lee believes we're entering a significant interest rate cutting cycle. So let's listen to the man himself.
The reality is the Fed is on a cutting cycle. That's really a good catalyst for rotation. Interest rates are going to fall, and it's going to help industries like housing, autos, credit cards come out of this recession.
So Lee isn't just talking about a single rate cut, but a series of cuts that could reshape the landscape that we're investing and trading in. He's painting a picture of falling rates, boosting sectors that have been struggling, potentially leading us out of what he sees as a sector-specific recession. And guess what? Goldman Sachs seems to be saying something rather similar. Their report indicates expectations for a 25-point cut in September, in November and December. And that aligns fairly closely with Lee's view of that cutting cycle. But we need to think this through. While rate cuts typically benefit the stock market, they're not a magic bullet. The timing and pace of the cuts, as well as the broader economic context, all play a role in this. So as the Fed is about to start cutting rates, are they really going to give us a cut at every meeting that's coming up? And if so, will it be enough to bring us to the soft landing that we're all hoping and praying for? So let's think about the tech sector, which is where I think most people are invested right now, which is experiencing a bit of a roller coaster. Tom has some intriguing insights on this matter as well.
Tech, I think, revealed its hand last week because NVIDIA had a good number, but it fell. So when stocks fall on good news, it's either a crowded trade or something bad could be coming. And then, of course, they've led the downside this week.
He's highlighting a classic market phenomenon here when good news fails to lift a stock. it often signals underlying issues. In this case, Nvidia's strong earnings weren't really enough to prevent a sell-off, potentially indicating a rather overcrowded trade, as in there's nobody else left to buy. But Lee doesn't stop here. He has an interesting theory about what might be driving this tech sector slowdown. Let's listen.
I think it is part of this pull forward the seasonality because people want to de-risk and tech is a big holding. But I think on the margin there could also be a political aspect to this. You know, Trump's probability of winning actually increased this week in the betting markets and in the polls, and I know investors think he'll be tough on China, which would be bad for semis.
So Lee's suggesting a two-pronged explanation here. One is the market de-risking, as we discussed, because everybody is expecting September, October not to be great. So why not take profits and sit on the sidelines, which is precisely what Tallulah and I have done. And then political factors, as in we don't quite know what's going to happen to tariffs and regulations post the US presidential election. But despite that turbulence, Lee remains bullish on tech in the long run, particularly on companies he likes, like Nvidia. So let's hear his perspective on valuations here.
Nvidia's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, Nvidia's forward PE, was actually higher at the bottom of those drawdowns. You know, right now, Nvidia's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes Nvidia down to the 90s, but I think 2 years from now, that's really going to be a gift.
Lee's taking a longer perspective here, suggesting that the current drawdown in Nvidia's stock price is within the normal parameters. He even goes so far as to say that current prices could be a gift for long-term investors, you know, as in buy the freaking dip. It's worth noting that his view aligns somewhat with Goldman Sachs' broader outlook. While they don't specifically focus on tech, their overall optimistic market view suggests potential upside for growth sectors like tech. So as we consider Lee's insights here on the tech sector, it's clear that while short-term madness persists, the long-term outlook might remain very, very positive, at least in his view. And this interplay between market dynamics, politics, fundamentals continue to shape the crucial sector that is tech. So is there a potential buying opportunity here? Well, Tom Lee has some rather intriguing thoughts on this matter. Let's hear what he says.
We're close to that point because let's say we thought that there would be a 7 to 10%, the risk of a 7 to 10% drawdown between now and November. We're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September.
So basically, Lee is suggesting that we might be nearing the bottom of this current market correction. But he doesn't stop there. He gives us some specific levels to actually watch out for. Let's listen.
I think we're close to the point where, I wouldn't be a seller here, and I think the lower range of the S&P's 5,400, 5,350, we're almost there now.
So he's giving us some specific S&P 500 levels to watch out for. He thinks 5,350 is the potential bottom, suggesting that as we approach that, it is a nice long-term buying opportunity. Interestingly, Goldman Sachs kind of puts out something fairly similar. It's almost as if one read the other's report. And they are suggesting that the current market pricing isn't really reflective of a recession, implying that there is potential upside if a recession is avoided. So it's clear that both are fairly optimistic. Lee particularly sees any market turbulence coming our way as potentially creating very attractive entry points. However, it's crucial to remember that timing the market perfectly is notoriously difficult, and what looks like a bottom can sometimes be a false floor. So the key takeaway here is that Lee believes we're approaching levels where the risk-reward becomes much more favorable for long-term buyers. But as always, consider your own risk tolerance, stomach lining, and investment horizon, and probably ask your cat. They're very, very good at risk management. Now, how much cash should you have in the market? And what really happens out there when we get a little bit of a mini dip? Well, Tom Lee gives us some particularly insightful insight here.
I know that there was panic that caused that 3-day drawdown, and the VIX spiked to 66, so we know that there was panic. But we also know there was a ton of cash on the sidelines already into August that was put to work.
So Lee is highlighting two elements here. The panic-driven sell-offs that we get from time to time, as we've seen in September, and then the subsequent deployment of sideline cash. And that interplay between fear and opportunity often shapes what actually makes the market. But he doesn't stop here. He draws a connection to global market dynamics. Let's listen to that.
I think part of this was a liquidity move because we know the yen was highly correlated with that move, and it's kind of happening again. The yen's turned strong, and it's been putting pressure on stocks.
In simple terms, Lee is looking beyond domestic factors. He's also considering the global currency movements, particularly the yen's newfound strength, as a key influencer on the stock dynamics. But really, Lee's comments on sideline cash remind us of a key market truism. There is often opportunity amidst panic. While it's never wise to catch a falling knife, periods of market stress can create attractive entry points for those with cash on hand and a strong stomach for volatility and a nice long time horizon. So as we wrap up our deep dive into Tom Lee's market insights here, let's take a moment to reflect on the key takeaways. Lee's perspective paints a picture of a market that's experiencing, yes, some short-term turbulence. September might continue into October, but with a potentially brighter future ahead. And his optimism about a soft landing, coupled with his view on the Fed's cutting cycle, suggests he sees opportunity on the horizon in the near term. So let's recap the main points. 1, the current market downturn might be a compressed version of the typical seasonal September-October weakness. And Lee sees strong employment data as supporting a soft landing scenario. Now, I'm very dubious as to the accuracy of US employment data, but that's another story. Lee also believes that we're entering a Fed cutting cycle, which could benefit a lot of sectors, especially tech and growth and fintech and so on. And he says the tech sell-off we've been experiencing might create attractive long-term buying opportunities. If we get another dip in September or October, he basically says, buy the freaking dip. Obviously, you have to come to your own conclusions on that. And then he touched a little bit upon the whole Japan yen scenario thing. Basically, in short, the yen goes up a lot. It's bad for US stocks. Now, I'm always an optimist because we can actually make money if the market goes up or down. It's actually slightly easier when it does go down, although it's gone up all year and we've done rather well with 93% up. So if you want to learn exactly how we did that 3-step trading system that Toledo and I employ, and that's brought us a $28,000 gain so far on a $30,000 teaching portfolio. It's intentionally small. Then come and join us next week for a 2-day beginner trading challenge. I put the link down below. I will teach you how we find the trades, how we automate profit taking and risk management, so you can basically continue with your life as it is and forget about the bloody thing once you set it up. That's always our goal. So grab your seat over there, and Toledo and I say thank you very much for watching, don't we? Winston and Felix here on this glorious morning with an update that's so freaking important. I'd say this is the most important thing that's happened in the last 5 years.